Venezuela holds more oil than Saudi Arabia, Russia, or the United States combined. Yet its refineries sit silent, and tankers arrive carrying fuel from abroad. Production collapsed from 3 million barrels daily to less than 700,000. For decades, this was the wealthiest nation in Latin America, built entirely on oil. Then the system broke. Engineers left, investors pulled back. The machinery rusted and stopped. Now, a political shift has created an opening that could reshape everything again. Opposition figures were detained. A new U.S. administration signals a different approach to Venezuela. The proposal on the table: let private oil companies return using their own capital. No taxpayer money, no government loans, just private firms deploying private funds for access. This isn't theoretical, it's happening now, and it represents one specific path forward. The question isn't whether Venezuela has oil, it's whether the systems can rebuild, and whether this approach, private capital for extraction rights, can work where others failed. In the 1970s, Venezuela was extraordinarily prosperous by regional standards. Oil revenue funded schools, hospitals, roads, subsidies. The middle class expanded rapidly across decades. Caracas looked like Miami. The currency was strong. Venezuelans vacationed abroad frequently and easily. The country produced 3.7 million barrels daily, supplying 11% of global markets. At that time, private oil companies operated under concessions, managing fields with foreign expertise. Then came nationalization in 1976. The government created PDVSA, the State Oil Company. For years, it worked brilliantly. PDVSA remained technically competent, autonomous, and internationally respected. Engineers were trained rigorously. Maintenance schedules were followed. Investment continued steadily into infrastructure upgrades. But slowly, political appointments replaced technical expertise at every level of management operations. Revenue was redirected from maintenance budgets into social programs, subsidies, and expanding government payrolls. Investment in refineries declined. Equipment aged past safe operational limits. Supply chains weakened gradually. By 2000, production had already started declining, despite global oil prices rising steadily. By 2010, output fell below 2 million barrels, even before sanctions arrived. By 2020, production dropped below 500,000 barrels, a 90% collapse. The oil didn't disappear. The reserves actually grew with new discoveries. The systems broke. Refineries corroded. Wells were sealed improperly and filled with sediment, becoming exponentially more expensive. Skilled engineers emigrated to Colombia and the US, Canada, anywhere that paid in stable currency. International companies remembered contract violations, expropriated assets, and nationalized investments without compensation terms. The resource remained abundant underground, but without systems to extract it, oil became irrelevant. This collapse followed a pattern seen before in oil-rich nations across decades. Iran's production fell from 6 million barrels to 1 million after 1979. Libya's fields were abandoned during civil war. Refineries bombed. Contracts voided. Companies evacuated. Iraq's infrastructure was sabotaged, neglected, then required hybrid partnerships to restart after 2003. Nigeria has faced chronic underinvestment, theft, and violence disrupting Delta production for decades. Mexico's state monopoly, Pemex, declined steadily as investment dropped and technical expertise aged out. In every case, the resource existed. In every case, the systems collapsed under political pressure. And in every case, recovery required a decision. Who rebuilds? Who pays? Who profits? Venezuela now faces that exact decision, and the current proposal represents one specific answer. The proposal is straightforward. Private oil companies return to Venezuela using only their capital. No US government funding. No taxpayer loans. Companies risk their own money for extraction rights. In exchange, they rebuild refineries, restore wells, deploy expertise, and take revenue shares as profit. This is what's called a concessions model. Companies get long-term access in exchange for investment. Chevron has already resumed limited operations under strict licenses, testing the waters cautiously and slowly. Other majors, ExxonMobil, Shell, BP, are reportedly in quiet discussions about similar deals under new terms. The mechanics are simple. Companies deploy capital fast because they're profit-driven, not bureaucracy-constrained. They don't wait for budget approvals, political cycles, or legislative debates before acting decisively. They bring equipment, expertise, supply chains, everything needed to restart production within months, not years. For Venezuela, this means infrastructure rebuilt without spending money it doesn't have available. Production could restart faster than any state-led recovery or hybrid partnership could achieve alone. Within 3 to 5 years, output could potentially return to 1 million barrels daily. Within a decade, potentially back to 2 million or more, depending on investment scale. This is Path 3, full privatization through long-term concessions. It's the fastest option available. But this path comes with specific trade-offs that history has demonstrated repeatedly across countries. Private companies maximize profit, not national development priorities or equitable wealth distribution across regions. They extract from the easiest, most profitable fields first, leaving harder, costlier fields untouched. Revenue splits favor companies heavily because they're absorbing all financial risk and political uncertainty. A typical deal might give the company 60 to 70% of revenue initially. Venezuela keeps sovereignty legally, but operational control belongs entirely to foreign companies for decades. And critically, if political power shifts again, new leaders could nationalize everything, restarting collapse. This exact dynamic played out in post-Soviet Russia during the 1990s privatization. Private companies flooded in. Production soared. Then Putin's government reclaimed control over key assets. It happened in Argentina when Repsol's YPF was nationalized suddenly in 2012. It happened in Bolivia when Morales nationalized gas fields after years of private operation. Speed came first. Revenue flowed. Then political backlash led to reversal and renewed uncertainty. The mechanics favor rapid recovery. The politics favor eventual conflict. History shows both happen predictably. There's also the question of who benefits domestically from this arrangement over time. Private companies hire locally, but management and high-skill positions often go to foreign experts. Revenue flows to the state, but if the state remains dysfunctional, wealth doesn't distribute. If inequality was already the source of collapse, rapid private extraction can deepen resentment. Citizens see foreign companies profiting massively while wages remain low and services stay broken. This creates political pressure for nationalization again, restarting the cycle of collapse and recovery. Venezuela nationalized oil in 1976, partly because citizens demanded control over national resources. If this path succeeds, that same demand could return within 10 to 15 years. The challenge isn't just restarting production, it's maintaining stability long enough for recovery to hold. That requires not just capital, but institutional strength Venezuela currently lacks after years of decay. There's a comparison worth examining. Norway versus Venezuela, two oil-rich nations with opposite outcomes. Both discovered massive oil reserves in the 1970s and had similar opportunities initially. Norway built a sovereign wealth fund, maintained strict technical meritocracy, and invested revenue strategically. It kept systems functional through discipline, transparency, and insulation of oil operations from politics. Venezuela spent revenue on subsidies, expanded government payrolls massively, and deferred maintenance continuously, indefinitely. Political control over PDVSA increased. Technical expertise declined. Systems weakened until they collapsed entirely. When oil prices fell, Norway's system absorbed the shock smoothly without major disruption. Venezuela's system collapsed immediately under its own weight, unable to adapt or sustain itself. The resource was the same. The outcomes diverged completely because systems were built differently. Norway chose institutions over spending. Venezuela chose spending over institutions. The results speak clearly. This historical comparison matters now because Venezuela must choose again how to structure recovery. Will institutions be rebuilt strong enough to sustain production long-term beyond initial capital injection? Or will revenue flow immediately into spending, leaving systems weak and vulnerable to future collapse? The current proposal solves the capital problem. It doesn't solve the institutional problem underneath. Historically, concessions models work best in countries with stable institutions and low political volatility. Kazakhstan opened its oil sector to private concessions in the 1990s and maintained stability. Companies invested heavily. Production grew steadily. Contracts were honored over decades without major disruption. The government stayed predictable. Companies felt secure. The system functioned because trust was maintained. But Kazakhstan had strong state capacity and centralized authority that enforced contracts consistently over time. Venezuela's institutions are currently weak after years of political turmoil, corruption, and economic collapse. Private companies will demand enormous premiums to offset perceived risk of future nationalization or default. They'll structure deals to recover investment quickly, maximizing short-term extraction over long-term field health. And they'll retain the right to exit immediately if conditions deteriorate politically or economically. This creates a tension. Venezuela needs long-term investment, but companies will prioritize short-term security. The success of this path depends entirely on whether institutional stability can rebuild alongside production. If stability holds, this works. If instability returns, companies leave and collapse repeats itself. There's also the broader geopolitical layer that shapes how this unfolds beyond just economics. Venezuela's oil has always been geopolitically significant because of its volume and proximity to markets. U.S. refineries on the Gulf Coast were designed specifically to process Venezuela's heavy crude. When Venezuelan oil disappeared, the U.S. imported more from Canada, Mexico, and elsewhere at higher cost. China and Russia filled the gap, providing loans and support in exchange for oil at discounted prices. But those arrangements were inefficient. Venezuelan production stayed low. Debt grew. Systems didn't rebuild. Now, a U.S. policy shift potentially reopens American companies' access to Venezuelan fields once again. This isn't just about oil. It's about influence, supply chain security, and regional stability. If American companies rebuild Venezuelan production, supply chains reorient westward, not eastward toward China. Revenue flows change. Political alignments shift. Regional dynamics adjust in response to capital flows. This makes the proposal attractive beyond just profit. It's also strategic for long-term energy security. But Venezuela must decide if that strategic value is worth ceding operational control for decades. Right now, Venezuela produces less oil than it did in 1945, before modern drilling. The oil remains the largest proven reserve on Earth. The systems remain broken after collapse. The current proposal, private capital in exchange for extraction rights, represents one specific path forward. It's the fastest path. It brings the most capital. It requires the least from the state. But it also carries the highest political risk the most sovereignty compromise, and the most reversal vulnerability. History shows this path works when institutions are strong and political stability is maintained consistently. History also shows this path fails when institutions are weak and political backlash leads to nationalization. Venezuela must choose knowing both outcomes are possible, perhaps even likely over different time horizons. The resource guarantees nothing. The systems determine everything, and systems require more than just capital. They require institutions, trust, expertise, maintenance, and stability sustained across decades, not just years. Whether this proposal succeeds depends not on oil underground, but on whether those conditions can hold. The oil will flow again eventually. The question is under what terms, for how long, and who benefits. That answer is being written now, in real time, as decisions are made and capital begins to move. If this system interests you, subscribe. The Vault holds deeper episodes on collapsed systems. Welcome to Luxona, the Netflix of finance.